Hello everyone and welcome back to the sessions on Advanced Strategic Financial Management. Friends, in this class we are continuing with the topic Advanced Capital Budgeting. This is the second part of the chapter, that is part 2 of Advanced Capital Budgeting. Now, initially I have told you what all we are going to discuss in the second part of Advanced Capital Budgeting, and as you can see, we are going to talk about risk analysis in capital budgeting. Now what happens throughout the process of capital budgeting? You are taking long-term investment decisions. Investment is made today and there is an expectation that there will be future recoveries in the form of future cash flows. So your cash outflow is happening today with an anticipation of huge amount of future cash inflow, and future cash inflow, nobody knows how much cash inflow the project or the company will be able to generate. As a result, what you are doing is just making estimations of those future cash inflows. When you are making those estimations of future cash inflows, you can never make those estimations with 100% certainty, because you cannot be 100% certain. It itself implies that the future is filled with uncertainty, and where there is uncertainty, there is risk involved, because you are expecting that in the future you will be able to generate so much amount of cash inflow. What if you don't get that much cash inflow? That uncertainty brings risk along with it. That means capital budgeting decisions are filled with uncertainties, leading to risk involved in your investment decisions. Now, you know, uncertainty and risk are such factors which can never be eliminated. For example, if I tell you that I have placed order of goods from another country and the goods will be delivered via seaway through a ship, there is a risk that the goods may be damaged in transit, there may be some kind of accident that may happen, and I may incur a loss. This uncertainty leads to risk, and such risk can never be eliminated. However, certain steps can be taken to manage the risk. In other words, to manage the loss that may arise out of that risk, and therefore we go for taking an insurance cover for the goods in transit. Correct? Exactly what we have to do here in capital budgeting. We have to understand the degree of risk involved in capital budgeting decision or in any investment scenario, and we have to analyze the type of risk, the degree of risk, the source of the risk. We have to do something to make sure that we will be able to tolerate that risk, and therefore we have varieties of techniques for incorporating the risk involved in capital budgeting in terms of understanding all the risks. When you are putting the decision making situation on the table, you should be aware of all the risks involved therein. Therefore, incorporating the information about the risk while you are taking a decision becomes very, very important. So risk will be there, but you not being aware of the risk and you being aware of the risk can change your aspect, can change your approach to your decision making. So let us do one thing. Based on what we have just discussed, let us write some important notes over here. So under the heading risk analysis in capital budgeting, please write: capital budgeting decisions are based on estimations of future cash flows. Such estimations cannot be made with 100% certainty. Therefore, uncertainty is associated with such estimations. Such uncertainty leads to risk. Capital budgeting decisions are based on the existence of risk and uncertainty. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. There are various ways for considering the risk involved in investment at the time of taking a capital budgeting decisions. These are broadly classified into the following. First comes the category of conventional techniques, which include risk adjusted discounting rate technique, that is RADR technique, certainty equivalent technique, that is CE technique. Then we have sensitivity analysis and we have scenario analysis. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and deal with the next part, that is the categories of techniques which are classified as statistical techniques, also known as modern techniques. The first one in this case will be probability approach, that is EVCF and ENPV. EVCF stands for expected value of cash flow and ENPV stands for expected net present value. Then we have standard deviation and CV, that is coefficient of variation with respect to EVCF. Then we have standard deviation and CV with respect to NPV. We will learn Hiller's model over here, dependent and independent cash flows, then decision tree approach, also classified as conditional probabilities, then dealing with real options, and then we have simulation techniques that can get involved. So please write up these different approaches under statistical techniques and then I take you ahead. Alright friends, once you have completed writing all these approaches, let us move ahead and write up the first heading under conventional techniques as risk adjusted discounting rate, that is RADR. Let me explain you something about this. Now this is a very basic, a very fundamental but a highly impactful technique under the traditional or conventional techniques. So basically, such conventional techniques which are still having wide applicability even at this scenario, that includes RADR technique definitely. Now what is RADR? It is risk adjusted discounting rate. So the idea is extremely simple. You find that there is a project which has risk and the degree of risk of various projects may be different. Some projects may be with a low degree of risk, some may be with a high degree of risk. You know, while learning the topics like portfolio, you have learned capital asset pricing model, where the beta of any investment will become the basis for identifying what should be the expected rate of return from such investment. The higher the risk of that investment, the higher will be the beta and the higher will be the expected rate of return. So basically, if you carefully look at what was the expected rate of return as per capital asset pricing model, you have a risk-free rate and to that you make adjustment of risk by adding some risk premium depending upon the beta of the investment. So here we are not buying any stock from stock market. We are making a direct investment, we are making a long-term investment into projects, into assets, into various kind of machineries, etc. As a result, when you are making a direct investment in a project, your investment will also have risk which can be measured through beta. Now this beta will not be beta of any equity share, neither a beta of any index. This will be beta of a project. So the idea remains same. You consider the risk-free rate, to that you make adjustment of risk. Now CAPM, capital asset pricing model, I have just indicated as an example of one of the approaches for determining RADR, that is risk adjusted discounting rate. There can be different ways of accommodating the risk to the discounting rate, that is aggregate of risk-free rate and the risk premium. So keep in mind one thing, as per RADR technique, the expected rate of return from any project will be its risk adjusted discounting rate, which is aggregate of two components. Number one, the risk-free rate, and number two, the premium that you should be awarded for taking the risk involved in that investment. So let us write some notes about RADR technique. So under the heading risk adjusted discounting rate technique, please write the cutoff rate is aggregate of risk-free rate plus risk premium. For example, the risk-free rate is 10% and premium for the risk involved in the project is 6%. Therefore, the risk-adjusted discounting rate shall be 10 plus 6, that is 16%. Different projects involve different degree of risk. Therefore, RADR for different projects can be different. So please write up this note and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. For example, the company has to decide on selection of one of the two projects, that is A and B, which are mutually exclusive, and further inform that project B is having more risk as compared to project A. The company adopts 12% per annum discounting rate for project A and 15% per annum discounting rate for project B. So basically, the higher discounting rate for more risky project and so on. It can therefore be concluded that the project having high risk should be analyzed using a higher discounting rate as compared to the project having lower risk. The basic idea in adopting this technique is to use higher discounting rate for higher risky project on relative basis, so that there has to be higher expectations for returns for higher risk involvement. So please write this whole note and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. We now talk about application of capital asset pricing model. So these techniques you have learnt while learning portfolio topic and share valuation already. The only thing that will differ now is the ERX given over here will indicate the expected rate of return on project X, and beta of X is actually the beta factor for the project X. So please write up this whole thing and then I take you ahead. Alright friends, once you have written this note about CAPM, let us try to recollect what is beta. We have learned that beta is a relative risk measure. It measures and indicates the risk of a particular project in relation with market. Just identify one thing. Here I am not talking about any security or any stock. Here I am talking about a project. That's the only difference. For example, if beta of project A is 1.2 times, it is understood that risk of project A is 1.2 times of the risk prevailing in the market. So quickly write this note and then I take you ahead. Alright friends, once you have completed writing this note, let us move ahead and write up this example. In this example, what is given? Observe, risk-free rate is 7% per annum. Rate of return in the market is 15% per annum. Beta of project X is 1.2 times. You are required to analyze the situation using capital asset pricing model and determine RADR for project X. Now, after learning CAPM already in the earlier topics, this is quite simple for you. You don't have to bother about this. You just try to understand one thing, that risk-free rate is 7%. To this we add the risk adjustment. You know one thing, 15 minus 7 will give you the risk premium. That is RM minus RF will give you risk premium. That is applicable for the degree of risk involved in the market. But beta of project X being 1.2 times, you multiply 1.2 to that risk premium of 15 minus 7, and 1.2 into 15 minus 7 will give you 1.2 into 8, that will be 9.6%. 9.6% premium added to the risk-free rate of 7% will make the risk-adjusted discounting rate as 16.6%. So let us observe what will happen over here. Rate of return in the market is 15%, risk-free rate is 7%. Difference between these two will be the risk premium. An investor who is ready to invest in the market would expect 15% per annum returns. that is 7% as risk-free rate and 8% as premium for taking the risk prevailing in the market. Project X has a beta of 1.2. That means the risk associated with Project X is 20% more than risk prevailing in the market. Therefore, the investor will definitely expect a higher reward for such high risk, that is by expecting 20% more premium. Therefore, the expected risk premium for the investor equals to 8 plus 20%, that is 9.6%. Here I do not emphasize that you must write this. It is up to you. If you just want to write, I am giving you time. You take note of this and then I take you ahead. Alright friends, I am sure you have finished writing this whole thing. Now what is needed for you to understand this one line ahead? So have you noticed what we have done? 15% is the rate of return prevailing in the market, which is filled with risk. Risk-free rate is given as 7%. So with risk you are expecting to earn 15%. Without risk you are going to earn only 7%. So what is that extra reward for taking risk? It is 15 minus 7, that is 8%. That 8% is the reward for taking the risk. If you take risk even more than the market, you should be expecting a little more reward, that will be extra premium. How much extra premium? Depending upon how much is the extra risk. Risk is 1.2 times of the market. So reward also should be 1.2 times of the market premium. So market risk premium is 8%, 1.2 times of that will be 9.6%. Or alternatively you can say 1.2 times risk prevailing in the market means 20% more risk. So 20% more risk indicates expectation of 20% more premium. So 20% more premium means 20% more than 8, and 20% when added to 8 it becomes 9.6% as your risk premium from this project. That 9.6 you would want to earn over and above 7%. So can you identify what will be your overall expected rate of return? 7 plus 8 was for the market, but for this project it will be 7 plus 9.6. So how much will be your expected rate of return? 7 plus 9.6 will give you 16.6% as your expected rate of return. Now that equation that you have seen, that equation, just check back, few minutes back you have written that equation. ERX equals to RF plus RM minus RF into beta. RF stands for risk-free rate, that is 7%. Then there is a plus sign, RF plus, within brackets what do you find? RM minus RF. RM minus RF means 15 minus 7. 15 minus 7 within brackets you will be getting 8. 8 into beta, that means 8 into 1.2. 8 into 1.2 will become what? 8 into 1.2 will become what? 9.6. And to that 9.6 you add risk-free rate of 7%, you get 16.6%. That is the formula, that is the model. So I told you, if you can understand this logic, you actually understand capital asset pricing model. Now every time in exam we cannot write this whole description. That is why that formula is there to ease out, that formula is there to save your time and effort in writing the calculation. So I will give you that other version also, that is with formula application, but let us first write one last concluding line over here. That last concluding line over here will be, therefore expected rate of return as per capital asset pricing model will be 7% plus 9.6%, that is equal to 16.6%, and applying the formula what we will get, ERX equals to RF plus RM minus RF into beta. And let us define these variables over here. ERX is the expected rate of return on project X. You can also call it as RADR, that is risk adjusted discounting rate as per CAPM. RF is the risk free rate, RM is rate of return on market, and beta of X is beta factor for project X. Let us try to substitute these values in this equation. So RF, here you will put 7%, here within brackets it will be 15 minus 7. 15 minus 7 means inside the bracket you will be getting 8. 8 into beta, beta is 1.2, so 8 into 1.2 will become 9.6, and 9.6 when added to 7%, that will give you 16.6%, which is expected rate of return on this project, or you can also call it as risk adjusted discounting rate. So please write up this whole thing and then I take you ahead. Alright friends, once you have finished writing these notes, let us move ahead and take up questions, and we get started with question number 1. Question number 1 says, determine the risk adjusted net present value of the following projects, and we have 3 projects in hand, that is a project X, Y and Z. What is informed to you? The net cash outlays, that is basically the initial investment required in the 3 projects, project life, annual cash inflow and coefficient of variation. Now you might be wondering, what is coefficient of variation? We'll be learning about coefficient of variation in details in the upcoming classes. As of now, let me just tell you one thing. Coefficient of variation is basically a factor that indicates the risk of the project. So if we identify what are the risks of the projects, for project X it is 1.2, for project Y it is 0.8, and for project Z it is 0.4. Sometime back, do you recollect, we have learnt what is beta? Beta is a measure of risk. Correct. The higher the beta, the greater is the risk. The lower the beta, the lesser is the risk. Exactly similar way, coefficient of variation is also a measure of risk. It is a measure of different type of risk. We will talk about this later. We have learned the concept of beta, but we have yet to learn what is coefficient of variation. Okay, but you will have to wait for upcoming classes for the same. As of now, what did I tell you? That consider this coefficient of variation as if it is giving you hint of the risk involved. So can you identify which one has a highest degree of coefficient of variation? Project X. Then the next one is project Y, and the lowest risk is with project Z. Now let us read further what is given in the question. The company selects risk adjusted rate of discount on the basis of the coefficient of variation. So coefficient of variation, they have given you the range, and accordingly what is the risk adjusted rate of return? In other words, what will be the corresponding risk adjusted discounting rate? So pertaining to what is the coefficient of variation, you have to identify what will be the RADR. So can you notice one thing? What were the coefficient of variation for the 3 projects earlier? If we observe, it is 1.2, 0.8 and 0.4 for X, Y and Z respectively. 1.2 is over here, 1.2 is over here. That means for project X, the applicable discounting rate will be what? 16%. Then for project Y it was 0.8, so it will be 14%, and for project Z it was 0.4, so it will be 12%. The higher the risk, the higher will be the discounting rate. The lower the risk, the lower will be the discounting rate. Are we clear with this concept? One more point. If you observe, zero coefficient of variation means no risk. In other words, it is a risk-free situation. At risk-free situation also, there is some rate of return given. Do you know, we have learnt about something like this as risk-free rate. Correct? When beta is 0 or when coefficient of variation is 0, it indicates completely risk-free situation, no risk at all. That time whatever rate of return they have given, that is basically risk-free rate. It's a hint of risk-free rate. I believe you people are understanding what I am trying to convey. So now let us do one thing. Let us see how to present the solution of this question, and more importantly, did you read the first line in the question? It says determine the risk adjusted net present value. That means basically you have to compute NPV of the project. You have to compute NPV of the 3 projects, but it is risk adjusted net present value, means the discounting rate that you apply for this must be RADR. If you have understood what I have just conveyed, let us begin writing the solution now. For project X, coefficient of variation is 1.2. the risk adjusted rate of return on 1.2 CV is given as 16%. It is directly given in the question. And then annual cash inflow is 70,000. PV of annuities will be 3.274 into 70,000. And you don't have to even compute this. This was already given in that table, right? And then from this PV of annuities, you subtract the PV of outflows and you get NPV. This NPV was computed on the basis of risk adjusted discounting rate. So it is basically risk adjusted NPV. So what I want you all to do is quickly write up this for project X, and then we shall move ahead with project Y and Z. Alright friends, once you have finished the calculation for project X, on the similar lines you will be able to do the calculations for project Y. I don't have to explain you again and again. So the calculation what we get for project Y is NPV based on risk adjusted discounting rate comes to rupees 24,186. Please write up this calculation and then I take you to project Z. Alright friends, once you have completed writing this much, let us move ahead and take up the calculations for project Z in the similar manner. Coefficient of variation over here is 0.4, so the risk adjusted discounting rate will be 12%. Annual cash flows, PV of annuities, multiplying, and we subtract from that the total PV of outflows, and we get 8,150 as NPV for project Z. At the end you may just write up the final conclusions what you got from your calculations. NPV of project X, Y and Z summarized. That's all. So please write up this whole thing and that will be end of the solution. Alright friends, once you have completed this entire solution, let us move ahead and take up the next question. A very good question on RADR, that is question number 2. Let us read this question. It says determine the risk adjusted net present value of the following projects. Again we have 3 projects X, Y and Z. Net cash outlays, different values or same values. This time we find same values, 6 lakhs, 6 lakhs, 6 lakhs. Project life is also same, 5 years, 5 years, 5 years. Annual cash inflow, it is different. So you find annual cash inflow, it is highest for project X, it is little lower for project Z and still lower for project Y. On the other side, with more cash inflow, you also find beta factor for project X is highest, then the next one is for Z, and the lowest beta factor is for Y. What is a clear indication over here? The higher the risk involved in a project, the greater is the annual cash inflow. Means it is a clear outcome. You take more risk, you get more money. You take less risk, you get less money. So now we have to identify what will be the risk adjusted NPV over here, but this time the risk is informed through beta. And previous question gave you a table of corresponding discounting rates with CV. This time you don't have any such rates given. What is given further? The company selects risk adjusted rate of discounting on the basis of the capital asset pricing model. That means question now is asking you to figure out what will be the RADR for each project based on CAPM, and then you will see that risk free rate is 10% and market return is 20% per annum. Now when you apply CAPM, you know what you have to do. From market returns you subtract the risk free rate, you will be getting the risk premium, correct? That is the reward for taking the risk. That reward you multiply with the beta of respective project and you will be getting what should be the risk premium for each of these projects. To that you again add back the risk free rate to arrive at the risk adjusted discounting rate. Once you get that, then computing anything further is no big deal. So let us see how to present the solution of this question. Here you would first write determining risk adjusted discounting rate for each individual project through CAPM. This is the equation of CAPM and I have explained you this equation already in details I don't have a need to explain anything further. So RADR for project X, just put up the values and you will see that RADR for project X comes to 26%, that for Y would come to 22%, and that for Z would come to 24%. So please carefully understand and write, don't just copy the content of the slide, understand and write, use your calculators, use your brains also. So please quickly write this and then I take you ahead. Alright friends, once you have completed the calculation of RADR for each project, the previous question annuity factors were given along with the information of RADR. This time nothing like that is informed, so you will have to even compute the annuity factor, but that is not a hassle for you. You have learnt it how to do that. So determining NPV of each project using RADR technique, beginning with project X, annual cash inflow, PV of annuities at 26% per annum for 5 years. The annuity factor, I don't have to tell you how we got this, 2.635071. Now multiplying that to annual cash inflow, you get the total PV of inflow. From that you subtract the total PV of outflow, and what you get is NPV. So this was NPV of project X. Quickly write it up and then I'll take you to the other two projects as well. Alright friends, once you have completed the calculation for project X, you get NPV of 1,11,469. We will make the same type of calculation for the other two projects. Beginning with project Y, you get annual cash inflow as 2,30,000, PV of annuities at 22% per annum for 5 years. Multiplying that, you get the total PV of inflows. From that you subtract the PV of outflows, and what you finally get is NPV, and the correct answer is 58,637. So quickly write up this and then I show you the calculations for project Z. Alright friends, once you have completed the calculations for project Y, let us move ahead and take up the calculations for project Z. Annual cash inflow, PV of annuities, multiplying that you get the total PV of inflow. From that you subtract the PV of outflow and you get NPV. Now the conclusion is what? As per RADR technique, project X is the best among the three projects analyzed above because it is giving you highest amount of NPV as per RADR. So please write up this calculation as well as that concluding line and then we shall move ahead. Alright friends, once you have completed writing this entire solution, let us move ahead and now talk about the next technique, that is certainty equivalent technique. Now there is an argument against RADR technique. Some thinkers believe that the major risk is associated with the future cash inflow, correct? Other factors which are variables in the project may not be that risky because not too much of uncertainty may be associated with those things, but the future cash inflow comes with the highest degree of uncertainty. So why not to make the adjustment in those cash flows rather than making the adjustment in the discounting rate? So certainty equivalent technique is introducing the concept of certainty equivalent factors. So you have a future cash flow estimate of say 10 lakhs which is uncertain, but the certainty equivalent factor is say 0.8. So you multiply the certainty equivalent factor, that is 0.8, to the uncertain amount of cash flow, and it would convert the cash flow into certainty equivalent cash flow, that is CECF, certainty equivalent cash flow. Now you might be wondering what are these CE factors and what is this certainty equivalent cash flow? Very simple. Based on what is the degree of confidence that you have, which you can say with almost a certainty that this much definitely will happen. For example, you are students. If I say I'll be conducting a test on AFM and I will put that test for 100 marks. These are the topics to be covered in the test. You have already learned these topics, and I am giving you additional 1 week time for thorough preparation, and then I will conduct the test for 100 marks. Now see what happens. Test is for 100 marks, but is your score going to be 100 marks? That is what you would want, 100 out of 100. But will it be 100? Possibly, yes. But is it certain? It is uncertain. It may be 100, it may be 90, it may be 80, it may be 70, it may be even 20 marks, depending upon the degree of preparation and the complexity involved in the test. And that is why the test that will be conducted after the week, the outcome of that test is uncertain. But based on your preparation, you are confident and you tell me that, sir, no matter what happens, no matter how you design the questions, I am sure that I will score at least 60 marks. That means you are confident about scoring at least 60. So the certainty equivalent factor will be 0.6 applied on a 100 mark test will make almost certain marks, almost certain, which we can call as certainty equivalent marks. So uncertain marks were 100, certainty equivalent factor was 0.6. So certainty equivalent marks will be 100 into 0.6, that is 60 marks. So here I gave you example of certainty equivalent factor applied on the marks scored in a test. You can just consider this certainty equivalent technique for computing certainty equivalent cash flows. So the cash flows that you are expecting to generate in future, those which are uncertain cash flows, you convert them into certainty equivalent cash flows. But keep in mind one thing, certainty equivalent cash flows are still future cash flows. You need to bring them down to their present values. So if I give you a project with say 4 years life, and I give you estimates of cash flows for each of the 4 years, with each cash flow which is an uncertain amount, I give you certainty equivalent factor. The question will inform you the certainty equivalent factor. So what you will do, uncertain cash flows multiplied to their respective certainty equivalent factors, you will be getting CECF. But keep in mind one thing, CECF, certainty equivalent cash flows are still future cash flows. You need to bring them down to its present value. When you want to arrive at the present value, you identify the PV factors and multiply those PV factors to those CECF. So certainty equivalent cash flows multiplied to their respective PV factors will give you the present value of CECF, which will be basically the total present value of inflows. And then from that you subtract the PV of outflow, you get the resulting NPV. Now one important precaution that you need to have is, when you want to compute the present value of these certainty equivalent cash flows, you be very careful that the discounting rate that you adopt must be risk-free rate. If you adopt any rate other than risk-free rate, it will be an error. Why? Because keep in mind one thing, no matter how risky the project is, but you will have to consider risk-free rate as your discounting rate. Else, if you make adjustment of risk with the discounting rate, it is basically RADR technique. We had problem with RADR technique, that is why we are introducing certainty equivalent technique, that do not make adjustment with the discounting rate, make the adjustment with the cash flows. When you have converted the uncertain amount of cash flows into certainty equivalent cash flows, now you must use the risk-free rate as a discounting rate to arrive at the present value of certainty equivalent cash flows. So let us do one thing, let us first write some notes about certainty equivalent technique, and then I will take you to the questions based on this particular technique. So when you start writing notes, under this heading, you write, this technique believes that uncertainty is associated with the future cash flows, and therefore it is not appropriate to adjust the discounting rate Instead, the future cash flows should be adjusted to certain cash flows or cash flows with certainty. This is done by multiplying factors known as certainty equivalent factors or CE factors. These factors can range between 0 and 1 in such a way that for higher certainty, a higher factor is adopted. So please write up this note and then I take you ahead. Alright friends, once you have completed writing this note, let us move ahead and write another very important note. It should be noted that under this approach, the discounting rate should necessarily be the risk-free rate because the element of risk has already been adjusted with the cash flows. So write this note quickly and then I take you ahead. Alright friends, once you have completed writing this note, let us move ahead and now we take up some examples given in your textbook and we begin with question number 3. Let us read this question. NJ Limited is considering one of the two mutually exclusive projects, Project A and Project B, which require cash outlays of rupees 10 lakhs each. The risk-free rate is 10%. The expected net cash flows and their certainty equivalents are as follows. Now notice one thing, for Project A they have given you 4 different cash flows for 4 years of life. Each cash flow is given along with their certainty equivalent factor, and same kind of information for Project B as well. Determine NPV of both the projects and decide which project should be selected based on certainty equivalent technique. So how are we going to solve this question? These are the estimated cash flows which are filled with uncertainty. That is what we have learned. What we will do is certainty equivalent cash flows will be ascertained. How to ascertain certainty equivalent cash flows? I have just explained you some time back that the estimated cash flow will be multiplied to its certainty equivalent factor. When you multiply this to this, you will be getting certainty equivalent cash flow. So for example, in Project A for year 1, it will be 4 lakhs as uncertain amount of cash flow, but its certainty equivalent factor given to you is 0.8. So 0.8 multiplied to 4 lakhs will give you 3,20,000. That means 4 lakh is the estimated cash flow, but it is uncertain. We are not sure whether we will get 4 lakhs or not, but we are pretty sure that we must get 3,20,000, and that is why 3,20,000 will be considered as not a certain amount of cash flow but certainty equivalent cash flow. So what we will do, guys, we will be multiplying 4 lakhs to 0.8, 5 lakhs to 0.7, 5,60,000 to 0.5 and 6 lakhs to 0.4 for obtaining certainty equivalent cash flows. But these are still future cash flows. They have to be discounted to their present values, and for that purpose 10% is the risk-free rate. Do you remember what I have explained you conceptually, that because the risk is already adjusted with the cash flows, you should not apply RADR over here. Okay, keep that thing in your mind, keep that as precaution. You should never apply RADR. The discounting rate that you must apply necessarily should be the risk-free rate. In this question, in fact, they have not given you any other rate for confusion. But imagine if the question conveys risk-free rate is 10% and RADR is 20%, it will be foolishness to adopt RADR under certainty equivalent technique. I hope you remember what I have conveyed to you theoretically and conceptually. You have to take precaution while solving questions. So once you know how to approach the solution, making that solution is just a formality. So we begin with Project A. Year cash flow CE factor, we get CECF, that is multiplying the cash flow with certainty equivalent factor, we will be getting CECF. Then multiplying the PV factors to that, we will be getting PV of CECF. So we start with year 1, 2, 3, 4. The reported cash flows in the question we will copy. The reported certainty equivalent factors in the question we will also copy the same. Then we get CECF, that is certainty equivalent cash flows. Then we plot the PV factors at 10% discounting rate, and then we convert these cash flows, that is certainty equivalent cash flows, which are still future cash flows, into their present values through these PV factors that we have identified. And when you take the total of that, it will be total PV of CECF as good as total PV of cash inflows, and from that you subtract the PV of cash outflows, and we get the result as NPV, net present value. Unfortunately for project A, we are getting a negative NPV. So please write up this calculation and then I take you ahead. Alright friends, once you have completed the calculations for project A, in the similar manner we will move ahead and make the calculations for project B. Exact same type of presentation, no difference at all. Of course the values what we get will be different, but the manner of calculation will remain same. So CE factors multiplied to the uncertain amount of cash flows will produce certainty equivalent cash flows, and when certainty equivalent cash flows multiplied to their respective PV factors, you get the PV of CECF. Total PV of inflow comes to 11,13,148. Subtracting the total PV of outflows, the resulting NPV is 1,13,148 positive. Conclusion will be, between the two projects, project B is better because it provides positive NPV. If your calculation goes a little here and there for difference of 1 or 2 rupees in terms of the final answer, that is okay, but too much of difference is not okay. So please make sure that you end up writing everything systematically and correctly, and then we shall proceed ahead. Alright friends, once you have completed this whole thing, let us move ahead and take up another question. That will be question number 4. Let us read this question. The Textile Manufacturing Company Limited is considering one of the two mutually exclusive proposals, Project M and Project N, which require cash outlays of rupees 8,50,000 and 8,25,000 respectively. The certainty equivalent approach is used in incorporating risk in capital budgeting. The current yield on government bonds is 6% and this is used as the risk-free rate. The expected net cash flows and their certainty equivalents are as follows. So let us look into that information. You have 3 years of project lives for both M and N, two projects, and their CE factors given along with their cash flows. The present value factor of rupee 1 discounted at 6% for end of year 1, 2 and 3, they are giving you the factors already. So you just have to apply these factors. These factors are given in just 3 places after decimal. Question is asking you which project should be accepted, and just like the earlier question, you can solve this and answer the same. But the second part of this question is little different. It is asking you, what it is asking you, carefully observe, if risk adjusted discounting rate method is used, that is RADR method is used, which project would be appraised with a higher rate and why? Now this is a conceptual question. Okay, what I will do is I'll bring back this line of question after we are done with answering the first part of the question where CE approach is required. So let us first apply the CE approach and finish the calculations quickly. So we begin with project M. I don't have to explain you again, it is the exact same way of calculation. You just have to apply the calculation exactly same way. Notice one thing, PV factors were given in the question, so you just have to apply those given PV factors itself. Thereafter, once you get the total PV of inflows, from that you subtract the PV of outflows, you get NPV as 10,980. Please write up these calculations quickly and then I take you ahead. Alright friends, once you have completed the calculations for project M, let us move ahead, and in the same manner you will be making calculations for project N as well. Over here, you just have to be careful that you don't apply wrong calculations. all the values are given in the question, including PV factors. So you just have to apply the calculations rightfully. Total PV of cash inflow is 9,96,315. PV of outflows is 8,25,000 for this project, and what you get as NPV is 1,71,315. Please write up these calculations quickly and then I take you ahead. Alright friends, I am sure your calculations are done already. Now one concluding line over here should be written. Between the two projects, project N is better because it provides more NPV, that is of rupees 1,71,315. That's all. We have yet to deal with the second part of the question, but first quickly write this concluding line and then we move ahead. Alright friends, once you have completed this conclusion, let me take you back to the question over here. Now I am displaying the second part of the question over here once again. Please carefully observe. It says if risk adjusted discount rate method is used, which project will be appraised with a higher rate and why? Now simply observe what are the CE factors for project M. 0.8, 0.7, 0.5. What are the CE factors for project N? 0.9, 0.8, 0.7. On comparison, can't you agree with me that project N has more certainty, project M has lesser certainty, because CE factors are lower over here and CE factors are higher over here. Also do one thing guys, also do one thing, because we cannot have just random comparison, we have to quantify that. Can you please take aggregate of these three factors, 0.8, 0.7 and 0.5? If I am not wrong, you should be getting 2.0, and if you take aggregate of 0.9, 0.8 and 0.7, I think you should be getting 2.4. So it is clear that the project N has greater certainty. Greater certainty means less uncertainty, correct? Less uncertainty means less risk. That means project N has lesser risk, project M has greater risk. Because project M has greater risk, if RADR was used, project M would have been appraised with a higher expected rate of return or higher RADR. Are you okay with what I am concluding over here? So let us see how to write up the answer for that part. Please write further in your solution. Certainty equivalent factors given in the question indicates the degree of certainty of cash flows that can arise in future. The aggregate of CE factors are given below. For project M it is 2.0 and for project N it is 2.4. From the aggregate CE factors as well as individual CE factors for each year, it is clear that project M has lower degree of certainty or higher degree of uncertainty, and hence higher degree of risk is found in project M as compared to project N. Therefore, if RADR technique is to be applied, then project M will be analyzed with a higher discounting rate because of its high risk. So please write up this complete answer for second part of the question and then we shall move ahead.